And here's our final balance day adjustment, accrued revenues. So accrued revenues are those revenues that we have earned in this current financial period, but when we reviewed our accounts, we recognised that we haven't received the revenue yet. And because we haven't received that revenue that we have earned, it won't be in the revenue account because it's only going to go into the revenue account when we receive it. So some examples of possible accrued revenues: commission revenue. We could have earned a revenue from our suppliers in commission. We've sold their particular products, and as an incentive they may pay us a commission. Also interest revenue on investments. We may have made some investments and we've earned interest on those investments, but that interest may not be paid by the financial institution until a later date. Rent can also be an accrued revenue. And here's our example. The business has earned a 5% commission on sales amounting to $1,000. On the 30th of June, the commission has still to be received. So we've sold $1,000 worth of stock for a particular supplier, and this supplier will, as an incentive, pay us 5% of any sales relating to their particular products, and it is an incentive. So it encourages us, I suppose, as a retailer to sell more of that product, and it represents a revenue. So we still haven't received that on the close of the financial period. So here's what the ledger is going to look like for commission. There is no commission revenue account because we haven't received the commission yet. So and that is a possibility with all of these balance day adjustments. Well, not all of them, but those that represent accrued revenues or accrued expenses. We may not actually have an account in the ledger relevant to that revenue or expense. So this is what we need to recognise, and that is that on balance day, the end of the accounting period, commission is still to be received, and we're most likely going to receive it in the next accounting period, but we've earned it in this accounting period. So according to the principles of accrual accounting, we need to make sure that we register this revenue of $50 for commission in this current accounting period because it was earned at present. The commission revenue account needs to be adjusted to show the total revenue earned in the accounting period. It's the matching principle. Revenue earned has to be matched to expenses incurred in order to determine what profit you've made. So this is a general journal that we're going to have to affect the double entry, and I think you can still see this. Accrued revenue will be debited 50. Now that represents an asset, a temporary asset, and commission revenue will be credited 50. So remember, this is a revenue account. We haven't received it. We have earned it, so we want to increase a commission revenue account, increase a revenue, you have to credit it. Something has to be debited, and we need to raise this temporary asset account. It's debited. How did I get the $50? Remember, it was 5% of $1,000 that we will receive in commission. 5% of 1,000 is $50. So this entry is going to raise the commission revenue by $50 because the amount was earned in this period. And it will also raise the temporary asset account, which is accrued revenue, because it is an amount that is owed to the business. That's why it's an asset. We are owed this $50. And here's what the accounts will look like. Here's our asset account, commission revenue. It's been debited. Sorry, accrued revenue is the asset account. It's been debited by $50 because it's an asset, you debit it. Commission revenue is the revenue. We want to increase it by 50 because it was earned this accounting period. So because this is an asset, it's going to be listed in our balance sheet, and given that this is a revenue, it's going to be closed off to P&L summary account, and it will also appear in our income statement. The very next day we need to perform a reversing entry, and here's the double entry for that. Commission revenue will be debited 50, commission revenue debited 50, and accrued revenue credit 50. So it's the opposite to what we did at the end of the last financial period. And here's what it will look like in the accounts. Here's my asset account. The reversing entry has the effect of closing that asset account because in the next accounting period, which is the current one now, that should be July 1 here, in this accounting period, it's no longer an asset. we are going to be receiving this revenue in this accounting period, so we no longer require this asset account in our ledger. Commission revenue account, you'll recall that the adjustment increased the revenue account by $50. It would have been closed off at the end of the accounting period to P&L summary, and now the reversing of it, here we have the account being debited by $50. And that's the case because that $50 was earned in the previous accounting period. When we eventually receive the commission from the supplier, it will be recorded in this account as a bank entry. The other account will be bank here, and it will be credited by 50. The balance then will be zero. And the reason why we want that to happen is that 50 was earned in the last accounting period, not in this current one. So the accrued revenue account is now closed, and the commission revenue account has been returned to, the $50 has been returned to the account, and it represents commission amount which will be received in this current accounting period, but was earned in the previous period. So the reversal entry will have the effect of reducing this balance to zero when that commission is eventually received. And that's your 4 balance day adjustments.